Hello and good afternoon, everyone, and welcome to Bull Prime's webinar. I'm Alex, your host today, and we have a special guest speaker to share inputs on essentials and key trading techniques. Whether you're new to trading or a seasoned trader wanting to expand your knowledge, we hope you find today's session informative and insightful. And just a note before we begin, the sharing session will last for approximately 45 minutes. And after the sharing, we'll make time for Q&A. So feel free to ask questions throughout the session in the Q&A section at the bottom of your screen. So without further ado, let me introduce you to our speaker for today. So he began trading at the age of 21 with just 500 US dollars, and he raised it to 13,000 US dollars within 2 years. Due to his success, he was featured on Singapore's Channel News Asia and won awards such as Most Popular FX Trainer in Asia Pacific and Top Forex Analyst by WikiFX. Now, financially independent individual, his goal is to help others achieve financial mastery by empowering individuals to design the life they want. So I present to you Kar Yong. Over to you.
Hi, good afternoon. So welcome to today's session. Thanks again for the quick introduction. Bo Prime for having me today, giving me the opportunity to share with you guys my strategy and approach towards the market, right? Towards the market itself. Hey, so without further ado, I'll read in the content, right? And as mentioned, if there's any questions throughout the Q&A tab, I'll look at those questions and answering during the Q&A session. Right. So today's topic over here would be the market, of course, sharing with you the framework to analyze and trade the market. Hey, and I call that the DF framework. To me, that's what I call a what's the market. Where if today you use the methodology or strategy, at the end of the day, the DSC come in handy. Okay, so what exactly is the DF framework? It constitutes three core elements of a profitable trade. Now, today, if you are fairly new to trading, this framework would give you a good head start. And of course, for those of you who are more experienced in the market, this framework would help you to gain a bit more clarity in terms of like which aspect of the three elements over here you would like to work maybe a little bit more to help you improve and see result in trading. Okay. So what exactly is the DSC framework? The first thing is direction. Now, this one is pretty common sense where today, if you want to take a trade, you want to have a high probability winning trade. Okay, the first thing to determine is which direction will the market likely move into the future. Okay, so that's where you need to have a technique, you need to have a method to determine direction. Okay, so obviously this can come from different methods, right? It can come from understanding the macro fundamentals of the market. For example, with the recent FOMC and Federal Reserve rate cuts, moving forward, there's a very good chance that we'll see the dollar continue to weaken, right? And of course, we also have the Bank of Japan hiking rates as of this year. So moving forward, there's a very high chance, good probability that the yen will continue to strengthen, right? So the fundamentals itself does provide some directional bias that we can actually work on, okay? So understanding the monetary policy, central bank's decision does provide that kind of direction. Now, on top of fundamentals, some traders utilize a lot of technical analysis, looking at charts, patterns, indicators to help them determine, at least in the near to mid-term, which direction would prices move going forward. Now, for me personally, majority of my analysis to determine direction comes from the charts, come from the technicals, but I do apply the fundamental understanding to see if there's a confluence in any of the trades that I'm taking, right? Fundamental also to me provide a longer term outlook, okay, which means that if today looking forward, for example, going in towards the end of the year, going into 2025, what is the overarching direction? The fundamentals will play a major role. But for a shorter term, swing trade kind of perspective from week to week, the technicals does provide me more insights, right? So my methodology over here when I approach the market, I would say it's about 60 to 70% comes from technical, and the remaining directional bias would come from the fundamental point of view. Now, another method that most traders may not be aware of is the sentiment perspective of the market. Now, sentiment analysis is more of a short-term view, where if there is any uncertainties happening in the market or there's any event that shake the market, creates fear in the market, that's where sentiment understanding comes in, right? And we have the term risk on, risk off, okay? So when there are uncertainty where there are fears in the market will transit into what we call a risk off environment. And during that stage, there are certain direction assets tends to move in a particular way. Okay, so that also can give us some sort of a directional bias in the short-term perspective, right? So if you take a look at this here, fundamental moving down to technical, moving down to sentiment, you can look at it from a perspective of long-term going into short-term methodology. Now, once you identify your directional bias, once you establish that, it's not enough for us to take a profitable trade, right? Because the next element is timing, right? We need to know exactly when to get in, when to get out, which price to get in, which price to get out. Okay. And that brings me to my second element of this framework called setup. Okay. So the setup over here is essentially identifying a condition or a set of criteria to allow us to actually execute a trade and manage the trade. Okay. So setup here encompasses strategy, depending on what strategy fits you as an individual trader. It comes in with the objective of providing you a rule-based method on executing and managing a trade, right? You can't be like, oh, today I feel good and then I enter a trade, right? That's not going to be very consistent. So you need to have a method, you need to have a strategy to execute and engage a trade. Okay. Now, if today you're more of a shorter term trader, trading sessions play an important role as well. For example, we have the Asian session, we have the London session, we have the US session. So each session itself, the market tends to behave slightly differently. So again, if you're doing more of an intraday short-term trader, sessions play an important role, right? So that comes into timing as well, that comes into your setup. Right. Now, today, if you are more into equities market or index or commodities, then seasonality would also play a vital role over here in terms of the time element, right? Seasonality, in short, is basically understanding from a year's perspective which month in particular there is a high probability where certain asset tends to move up or down, right? And during that particular season, that becomes a prime time for us to then engage and look for opportunities within the asset class itself. Okay. So in terms of currency market, seldom we use seasonality in part of our setup. But if today, as I mentioned, you're looking at equities, especially in the US, indices, or perhaps a little bit on the commodity side of things, seasonality would help to give you a better time window to know when to actually focus on that particular trade. Right? So if you're able to cover these two elements, right, direction as well as setup, there's a very good chance, there's a very high probability you'll be able to identify winning trades. But if today you want it to have an even better odds, right, that's where we want to add in the element of context. Okay. So what constitutes to this component within the context structure itself is where we talk about confluences. Okay, which means that if today I have a setup, I have a direction, I would also like to seek out for more confluences. It can be within technical analysis itself to find confluences. It can be combining and comparing technical and fundamental to find confluences. It can be seasonality to give you the extra confluence. It can be multi-asset. Okay, looking at inter-market confluences. Essentially, you're finding more elements to support your trading plan, to support your setup, to support the trade itself. Okay, and that's what I meant by confluences. Now, we also talk about multi-time frame alignment, right? So if today your main trading time frame is, let's say, for example, the hourly chart, you might want to consider looking at maybe the H4 time frame to find confluences, to find alignment. right? If you're trading on a H4, you might want to go up to the daily chart to see if there's any form of alignment between the different time frame, right? The whole idea about multi-time frame is to not be overly focused and zoom in on a particular view, but to really look at the market in a multi-pronged approach, okay? From a short-term to the longer-term perspective. What is the market doing? Where is the price now? And that gives you additional layer of confluences, okay, and context as well. And last but not least, in terms of risk management perspective, that's also the content element that I put in. We talk about risk to reward ratio as well. Okay, taking a trade, what we call A plus setup versus maybe just a valid setup. Okay, there are multiple elements that go in as well. One of it is risk to reward ratio and asking ourselves the question, is this trade worth taking? Okay, so all these things come together. And I want to start off by really giving you an overarching framework of the DSC approach, right? Because you can be using, as I mentioned, a lot of different methodologies, different setups, because different traders will have different preferences. But at the end of the day, a complete holistic approach and strategy towards the market will need to have these elements inside it. Okay, directional bias setup as well as the context. Okay, so bear that in mind as we progress in today's webinar. Okay. So over here, in each of this component, I'll be talking about the techniques I personally use, hopefully to give you a base to start off with if you're very new. If you're already a little bit more experienced, then hopefully sharing with you my method over here might give you some insights to see how you can actually complement with what you already have, or even add on to what you already have been using so far. Okay, now let's talk about directional bias. Just to very quickly touch on the elements I'm gonna share with you within this directional aspect of things comes from the principle of Elliott wave. Okay, it's not gonna be as complex as Elliott wave. I'll kind of break it down to the essence of it, but the elements and the principles does come from Elliott wave principle itself. Okay, so over here, establishing directional bias is always the first thing that I will want to do whenever I look at a chart or I look at the market, right? I need to first know, do I have a clear direction that I can be focusing on? If there isn't, I'll move to the next one, right? But if there's a clear direction, then that's where we progress to the next stage. Do I have a setup? Do I have confluences? Do I have contacts to support my trade? Okay, so the first thing is always going to be direction bias, right? And for me over here, using technical analysis to establish my direction bias, I'm only going to be focusing on two types of patterns. One is what I call the continuation pattern, and the other one is called a reversal pattern. Okay, now what's a continuation pattern? If I kind of just draw a little bit, we have what we call an impulse plus correction. Okay, now what's an impulse? Impulse is essentially when the market made a move with momentum, whether is it going up or coming down, as long as there's a strong momentum, we call that impulse. Okay. Now, correction is when the market is basically going up or coming down in a very slow manner. Okay, so it kind of bounce up and down, up and down. It can be tilting, slanting to the upside. It can be slanting to the downside. As long as the market is not going with momentum, we call that correction. Okay, so at the end of the day, we do have a couple of combination over here. Okay, let me just clean this up a little bit. Right, so when we have an impulse correction combination, right, basically means that if we have an impulsive move to the upside, following that, the market retraces in a corrective manner. This is what we call a continuation pattern because there's a high probability the market will continue higher. Now, if you flip that, if the market came down, impulsive with momentum, and the market starts to correct to the upside slowly, then that's where we have a high probability direction, right? So that's what we call continuation pattern. In a while, I'll show you some examples on the chart as well. Now, the other one is called an impulse crawl. How they look like essentially is when we have a first move up with momentum, and the market continued to climb higher, but it's starting to slow down, right? So essentially, this is what we call crawl pattern. It's a reversal pattern because there's a high probability the market would reverse. Similarly, the market came down with momentum and it starts to do a slow move to the downside. This kind of pattern would indicate a reversal and we want to focus on the upside. Right? So by understanding these patterns over here, it allows you to very quickly identify, do we have a directional bias? If we don't identify any of this pattern, if you can't see them very clearly on a chart, then there is basically no direction. There's no high probability that we can really forecast where the market would likely hit next. We'll skip on that and then we'll wait until a pattern that we can recognize actually develops. Right? So I'll give you some example over here, right? So this is the illustration, right, where we have an impulsive move to the upside, a corrective pullback. We expect the market to move higher. And the opposite here is we have an impulsive move to the downside, the market move up correctively, retrace correctively, and we expect it to continue to move lower, right? So these are continuation patterns. Now, how they look like on the chart, you can see here, impulse push, mini correction, impulse push, mini correction, and the market continue in its direction, right? Impulse correction, continuation, impulse correction, continuation. Now, the same thing here for the downside, impulse correction, continuation, impulse correction, continuation, impulse correction, continuation. Right. So from historical pattern, we can start to identify and figure that, all right, this is a high probability pattern. So what this means is that moving forward, right, when you open up a chart on any particular time frame and you start to look at it from the pattern recognition perspective, you want to ask yourself, how is price developing? Right? So a little clue and a little trick here is when the market is here, you ask yourself, how did the market arrive towards this price? It came from this high, it came down, from this low, it went up. And then basically you backtrack a little bit, right? How did the market eventually reach this area? It came down, went up, came down, went up, came down, went up, came down, and we are here. Now, this entire move, you start to realize that there's a lot of overlapping sequence, right? Right, up, down, up. This essentially is a slow moving correction. Prior to that, what do we have? We have a very strong move to the upside. So what we can then very clearly see is this is an impulse, this is a correction. When we get this combination, that's where we have a very clear direction that we can look out for. Impulse, correction, expectation here, focus here, the bias here is upside. All right, and that's what we're going to expect, and eventually that's what the market gave us. Okay, I hope you can follow along the way up to this point in time. Okay, now if you flip it, it's the same thing, right? We have the market coming down, and then right now we're here, right? So same thing. You want to ask yourself, how did we arrive at this point, right? The market up and down, and then we're basically in a slow moving sideways, slightly tilting to the upside move. Previously, very fast drop, impulse correction. This combination again suggests that we have a clear pattern, we have a clear direction of bias, and that's going to be bearish. All right, and that's what the market eventually evolved into. Okay. So when we start to be able to recognize this pattern, when we open up a chart on any particular time frame, when we want to establish a directional bias, we always just ask ourselves, do we have a pattern that we can recognize? Right now, very quickly, I'll show you another one which kind of touch on a little bit just now. We call it frog pattern. So we have an initial impulsive leg to the upside, and then the market continues to slowly crawl to the upside. That's a crawl. That's a reversal sign. Similarly here, if you get an impulsive drop and the market continue to drop, but it's slowing down, it's a crawl, it's a reversal sign. Okay. So I give you an example, you can see over here, right? We have an impulse leg to the upside, and then it starts to crawl, the market reverses, forming an impulse, and then it starts to pull back, giving you a correction, and then a continuation, right? So over here, we actually have a two pattern combination, right? First, we have a crawl that gives us a reversal, and then we have an impulse correction, which gives us a continuation. Okay, so that's the beauty of the part of the market and the patterns, right? They can sometimes develop one after another. Okay, similarly here we have a crawl. right? You see the market continue to drop, but it's slowing down. There's a lot of overlapping. And then we get a reversal, and then the market forms a correction, and then a continuation. Okay. Now, how does this being applied to the live market environment? If today you open up a chart, it's actually the same trick. Okay. The price is here, you ask yourself, how did the market reach this price? Right? Then you start to realize, oh, it did a lot of ups and downs, slightly coming lower, but there's not much of a momentum. Previously, we had a strong momentum push. So this forms a crawl development. What does this tell us? It means that this is very likely a reversal sign, and the direction that we want to be focusing on is bullish, right? And that's what we get. Very nice little pattern. If you flip it on the opposite, this is also very, very clear. Okay, price is here. You ask yourself again, how did price arrive to this point? Came up, we came down, we went up, we came down, we went up again. Very, very slow in its development. Previously, we have one impulsive leg. That's a crawl, right? And what is the directional bias? Bearish. We do expect price eventually to come back down. That's a high odds of that happening. And that's what the market gave us. All right. So very, very quickly, right? I'm just gonna give you some like live market examples over here on, let's say, the dollar Canadian. Okay, sorry, let me just open up a clean chart so that it doesn't clutter the charts a little bit. Okay, now over here, what we have the dollar Canadian. Again, doesn't really matter what time frame as of now, but I'm just giving you an example based on the H4 perspective. Okay, market is here again. You want to ask yourself, right? How did we reach this point? The market from this low went up, came down, went up, came down, went up, and overall you can see it's just slow moving. Okay, previously what happened? The market came down impulsive. All this suggests that it's an impulse correction we are expecting downside. Okay, so that's the pattern recognition perspective. Now, on top of that, right, on the smaller scale perspective, we can also see an impulse leg up. And then after that, the market continued to climb higher, but it's slowing down, right? So that's an inner crawl pattern that forms a rejection. Okay, so that's where you can see patterns within patterns itself. I'll give you an example. Okay, dollar yen. What do we have as the market is coming down? We have up, down, up, down. Very, very slow in its development. Previously, it came down a little bit with momentum. That's a crawl. The market starts to reverse. Okay, so I just want to give you some examples. Sometimes it's a little bit clearer in certain charts. Sometimes it's unclear. You just focus on those that are clearer for you, those that are giving you a clear directional bias. Okay. Same thing if you play around with different instruments. This is on gold. Right? So you can see patterns of this here being very, very corrective in nature. Previously, it came out fast, sideways, impulse correction, continuation. Now, right now, if you take a look at what's developing over here, it may not be the cleanest because this may start to form what we know as a crawl, but not yet. Okay. So sometimes when you open up a chart, if the pattern doesn't really show up very obviously, you just want to be patient because as the market continue to develop, things would often get clearer, okay, as we progress. So sometimes things are not clear, you just leave it aside. Go. Okay, hope so far so good. Okay, so that's what we call directional bias, right? Looking at patterns, identify a clear direction that we want to be focusing on. Okay. Now, for those of you who have some questions, again, just drop it into Q&A later. During the Q&A section, we'll be looking at those questions. Okay. Now, once we have a directional bias, right, it doesn't mean that immediately we jump in to take a trade on the buy or the sell, right? We need to have a setup. We need to know where to enter, where to put our stop loss, where to put our potential take profit. Okay. And that's where the second component, the second element comes in, right? That's where we talk about setup. Okay. Now, setup, again, there are many ways in which we can have a trade setup. You can be utilizing price action. You can be utilizing indicator base. You can be using Fibonacci, etc. Okay. For me today, I'm just going to share with you a simple technique called the order flow strategy. Okay, there are more than one way to execute a trade. You can always mix and match. Okay, you can kind of design your own, taking elements from different aspects and then combining them. So today, just want you to be aware, this is not the only strategy, but this is one of it. Okay, so what's an order flow strategy? What are some of the steps and processes? Over here is an overview, right? The first step is to establish market structure direction. So ideally, we want the market structure direction to be the same direction as what we have forecasted, right? So if we have an impulse followed by a correction, we have a bias to the upside. We want the market structure to be in line with the upside, right? We want to have a bullish market structure. So ideally, we want the market direction, market structure direction to be the same as our bias. Okay, so that's the first thing. Second thing is to identify order block, right? We call this supply and demand zone, depending on whether you're looking to buy or looking to sell. If you're buying, we're focusing on the demand. If you're selling, you're focusing on the supply zone. Okay, so we identify and establish our order block. That's the second stage. Then the third step is basically put in our entry near the order block, or we can even use Fibonacci ratios as part of our confluences. Okay, and then our stop and target will be using our previous structure highs and lows. Okay, it's a very, very straightforward mechanical strategy. Okay, just that you need to understand a little bit more into like how to identify order block. Okay, so I'll share with you on that in a while. Now, I'll give you the model of the strategy first, right? So today, if you're looking to take a trade, the first step, as I mentioned, you need to have a market structure break, which is where the market structure direction is going to be the same as our forecasted one, right? So we have a move to the upside, we form a high, the market pull back, we form a low, and then the market move up further, breaking that previous high. That's what we call a market structure break. Okay, so this means that we are in a bullish market. Okay, then what we do is we wait for the pullback towards our order block as a demand area, and then we look for entry. Okay, so this is the general model, the framework in terms of how we look to buy, and this is how we look to sell. Okay, so again, we kind of recognize this a little bit, okay, so that you know as we progress, right, what are some of the steps. Okay, you wait for market structure break, whether is it bullish or bearish, wait for the pullback towards order block. That's where we take our trade. Okay, now how do we then establish our order block? Okay, the first thing here is to first understand fair value gaps, or in short, we call it FVG. Okay, so fair value gaps are often created when the market momentum is very strong. Okay, so this is actually pretty similar to the principle of impulse leg. When the market creates an impulsive move, it means that it's strong in momentum, and often that will have fair value gap within it. Okay, so in equities and indices, right, your price gaps itself are essentially fair value gaps. But in an FX market, because most of the time we don't see a gap, we'll then utilize a 3-candle pattern to identify FVG. Okay, so how does this 3-candle pattern looks like? Over here. Okay. First up, first up on the left, okay, it's a bullish market. And what we observe is that this second candle body is very huge. That's where we have huge momentum. And then we also realize that the candle on the left, the candle on the right, they did not overlap. And that leaves us with a gap, and we call this fair value gap. Similarly over here, okay, you can see this candle here, the body is huge. The candle on the left, candle on the right did not overlap. So that itself, again, leaves behind what we call a fair value gap. Okay? So again, very, very clear, very distinct way of understanding what FVG is. Okay? Now, once you identify fair value gaps, the order block, the simplest way to identify it is we use the first candle that created the fair value gap, which means that The candle on the left that creates the fair value gap is essentially your order block. So if you're in a bullish market, the order block is a demand. If we're in a bearish market structure, the order block is a supply. Coming back to this example, bullish candle, first candle creates the demand zone. Bearish side, the first candle creates the supply zone. Very simple. Okay, obviously this is the foundation aspect of things. As you progress and you move forward, as a trader, then you start to learn a little bit more advanced principle. Okay. So coming back to the model itself, right? This is where you can see market structure break. We have fair value gap. That's your demand zone. Essentially, if the market pulls back, that's where we want to look to buy. Our stop is at the swing low. Our target is the swing high. Okay. So that's the essential foundation of this model. Okay, so we have an entry, we have stop, our take profit, and that's how the market tags in very nicely, move towards the target and hit it. Okay, now in the bearish market model, what do we have? Same thing, right? We have a market structure break, we have an impulsive move, we have a fair value gap, we have our order block, supply zone. We basically wait for the market to pull back towards the order block. We have our swing high as our stop, our swing low as our target, and the market basically reacts off this order block very nicely. Okay. Now, if you're more experienced, obviously you can add in more elements to your analysis of this, right? You can add in Fibonacci ratios as a confluence. You can utilize candlestick formation near the order block as your confluence. You can also utilize principles such as like support resistance, etc. Okay. Just bear in mind that what we're covering today gives you a solid foundation to build upon. It doesn't mean that this is the only way to do things. Okay. Just want to like remind everyone over here. Okay. So very quickly, again, I'll jump back to the current market to really give you some examples, on the application of things as well. And then very quickly, I'll pass the time back and see if you have any questions. Okay. Now I'll come back to dollar Canadian over here, right? So just now we did talk about the direction on this pattern, right? We're essentially looking for downside. Technical pattern here suggests that the fundamentals also support the case where the dollar would likely continue to weaken. We'll see a little bit more downside moving forward too. Okay, so we have the direction kind of like established. Our directional bias is down. Then what we can do is we can then now go down to the lower time frame and start to identify where are areas in which we can potentially execute a trade. Okay, so first thing, we do see this on the hourly impulsive leg. Okay, do we have a fair value gap, right? So if kind of zoom in a little bit over here, we do identify that we have this fair value gap. Okay, and if that's going to be our fair value gap, then naturally this would be our order block, right? If you're going to start off immediately from the baseline, okay? If you're a little bit more advanced, you can actually stretch this all here, and this entire area essentially is your order block. Okay, why? Because the market actually made a move up first here before it drops impulsively, breaking this minor structure here. So this entire bullish move can be your order block. Okay, that's a little bit on the advanced side, but I'm just covering now a little bit for you guys. Okay, so if that's going to be your order block, then what we'll be looking out for is that if the market continues to pull back into this area, that's where we're going to be looking for an opportunity to sell it down. Okay, now if today you want to find out a little bit more in terms of like Fibonacci confluences and things like that, you can even pull your Fib from swing high to swing low. Okay, and 71% Fibonacci would often be a ideal area to look for entry. Okay, and of course your stop will go above your swing high. Your target is where your swing low is. Very beautiful risk to reward ratio of 2.36. Okay, so again, this is not a trade signal directly, but I'm just giving you practical examples of how we can establish the DSC framework. Okay, from a bearish market perspective, we can even look for more targets down here, right? But the whole idea here you can see is from a 4-hour chart, we establish the pattern, we establish our directional bias, and then we can drop down to the lower time frame to look for a setup, right? So that's the progression that you would want to really see. Okay. Now very common, people like to talk about gold. But again, you don't want to jump in immediately to see whether you want to be buying or selling, or is there a setup. The first thing to always look at is, do I have a clear directional bias? Okay, if there isn't a directional bias, you don't progress within the DSC framework, right? It's always left to right. You want to see, do you have a clear directional bias in terms of pattern first before jumping into the setup phase? Okay, so if gold here doesn't really have a nice pattern that I can recognize, it doesn't give me a clear directional bias, then there really isn't much of a trade there. Okay. Give you another example. Okay, we kind of talk a little bit about dollar yen just now, giving us that floor pattern. We had a nice decent bounce. Then we move on to our setup phase, right? So in our setup phase, do we have anything over here? Okay, at this point in time, we really don't have much as of today. This year has a nice little bullish move, but there's really no fair value gap. There's really nothing we can move and take trades on, right? So again, you want to be very clear, right? During the DSC, using the DSC framework, we have a direction. If you don't have a setup, that means the timing is not there yet. You don't want to take a trade first. You don't want to force things in, okay? What you can do is you can wait for price to maybe make a move higher first, and then during this leg here, you might have some fair value gap. And when the market pulls back, that's your opportunity to take the buy trade, okay? Sometimes part of trading is just basically wait, okay? Sit and wait for price to give you the setup that you want. Cool? Right? So I hope so far up to this point, everyone is clear in terms of what the DSC framework is. I'll very quickly pass the time back to Bull Prime here and see if there's any questions coming in. We'll be answering the questions as much as we can.
All right. Thank you so much, Kar Yong, for the great sharing. And I can see that there are questions coming in, but if any of you have any questions for our speakers, do write them on the Q&A section at the bottom of the screen. I repeat, if you have any questions, do write them down on the Q&A section at the bottom of the screen. So let's move on to the first question by Amelia. And this is I would say this is pretty fundamental question. So the question is, what is FVG and what is MSB?
All right. FVG is it stands for basically fair value gap. Hopefully just now when I explain it, it becomes a little bit clearer. MSB stands for market structure break. So market structure break essentially is when the market breaks previous highs and lows. When they break certain structure, we kind of just label it as MSB, right? So for example, if the market is in a bullish market structure, if it's in an uptrend, it tends to form higher high and higher low. So as the market continues to break previous highs and it forms higher lows, that's where we have like MSB, right? We have market structure break, and of course vice versa. If it's coming down, it's the same principle. When it breaks previous low, you get a market structure break. It kind of indicates that we're in a bearish market structure.
Okay, great. So moving on to the next question. So I think this has been answered by one of our representative earlier. So just want to get your opinion on this one. What is the best risk management tips for a casual trader?
All right. So I would say generally there isn't a fixed rule in terms of like risk management, but the whole idea is always assess yourself, right? Even from a psychological point of view, whenever you're taking trades, is that particular trade affecting you as an individual, right? In a way where if you realize that subconsciously you're always feeling anxious of a particular trade, you're feeling that, worried about this trade, you're kind of distracted by the trade that you're in, then in a way that particular trade has been impacting you psychologically. And often that drops clues to tell us that, all right, perhaps you are risking a little bit too much on that particular trade, right? And that's where you start to make the adjustment in terms of like lowering your risk a little bit, so that in the future, in the next trade, if it doesn't impact you as much, then all right, you're probably fine-tuning what's the optimum risk for you as an individual. Okay. I mean, a lot of times we hear traders say, oh, never risk more than 1%, never risk more than 2%. But to me, that's a little bit arbitrary, right? Because some traders, they're high risk taker. 1 to 2% per trade to them is like too slow, right? And it doesn't fit them. And then there are also very, very conservative traders where you ask them to risk 2%, it might be a little bit too much for them. So there's really no kind of like fixed answer to that. There's no hard rules onto that. It's really about balancing what is comfortable to you, right? So I think, as a trader, in terms of risk management, at the end of the day, is really what are you comfortable with and how much risk can you actually accept, right? So once you are able to answer that yourself, that's your optimum risk management plan.
All right. So the next question from an anonymous attendee. So what are the best tools or software do you recommend that can help traders implement these techniques?
I would say there's no. I mean, I personally don't use any kind of like proprietary software or tools. If today you are comfortable with MT4, MT5, that works. A lot of the analysis and the charting perspective, the tools I use like Fibonacci's, drawing lines and things, they're all readily available on, any MT4, MT5 platforms. If you would like a web browser, I personally like use TradingView as my charting. So basically that's all you really need, I would say. I don't use any sort of like sophisticated indicator, right? So then for me, it's basically as long as a platform has a charts, you're comfortable with it, just learn how to use that, and then that's about it.
Great. So another tools related question here, but this is more of comparative. Supply and demand or engulfing, which one is the best? What do you think?
All right. I don't trade based on candlestick patterns and formation. So a lot of the setups, a lot of the trades that I take are all based on pending orders. Which means that once I identify a key area that I would like to execute a trade, I'll just place a pending limit, whether is it buy limit or sell limit. And then I'll just leave it as it is. If the market hits and tag me in, then I'll be in a trade. If not, then I won't be in a trade. So I don't really use a lot of like candlestick confirmation, like engulfing or kind of pin bar, right? So my style is I just leave it as limit orders. I identify areas like supply and demand. I identify areas based on Fibonacci, and I just trade based off those levels, right? I mean, different traders have different preference, so I think at the end of the day, it's more like testing both out and see which one you're more confident and more comfortable with, right? So at the end of the day, it's really about personal choice and preference.
Okay. Uh, so another question, but this time is more towards the time frame. So what is your recommended time frame to use this technique?
I would suggest start off with the 4 hour chart, and hopefully you can consider to move down to the hourly. However, if you want to start using this on a lower time frame, like the 15-minute or maybe the 30-minute time frame, you need to be, of course, a little bit more experienced in the technique, and you need to spend a little bit more time in front of your computer because the 15-minute time frame and 30-minute time frame, things can really evolve pretty quickly. You need to adapt to the market also pretty quickly. So if you're fairly new, the time frame to perhaps get started is somewhere between a good balance of like H1 and the H4 chart. Anything above H4 to me, I think it's really too long in terms of like if you want to execute a trade on a daily time frame, it is just really gonna take very long, right, for a setup to establish. And then even if you're in a trade, you're gonna take like maybe months before you have the outcome of it. And I think that's a little bit too long for most traders. So a good balance, again, I would suggest is somewhere between 4 hour and a H1 as a good start.
Great. Another question here. Which time frame recommended for zoning?
Yeah, so I would say more or less the same answer. Probably you're gonna start off with H4 or H1, and then you just drop like one time frame lower to really fine tune the details of your execution phase, like where to enter and things like that. You might drop just one time frame lower, so that you can reduce your risk a little bit. You can tighten your stop loss and it can increase your risk to reward ratio. But in terms of like the best time frame for identify key areas for drawing your zones, probably the H1 or H4.
Here's a psychological related question here by Muhammad Khairil Hadri. And he's asking how to control emotions when setup failed.
Right. So I think the first thing here is to first I think as a trader you naturally need to accept the fact that not all trades, not all setups are going to be winning trades. They're bound to be losing trades. That's part of trading. So you need to obviously accept that, right? I mean, if today you come into the markets and thinking that I want to find 100% hit rate, you're gonna struggle a lot because you're probably not going to find that, and unless you change that inner belief that you need to accept losing trades, that's one thing. And of course, the other aspect on the psychological emotion aspect of when the setup doesn't work out, is the risk aspect, right? I mean, if today you accept the fact that you're not going to win every trade, then naturally you need to have a risk management plan. And if you've done your proper risk management plan, again, it should be at the stage where losing one or two trades shouldn't impact you psychologically because it's part of the journey itself, it's part of your trading activity. Perhaps out of 10 trades, you might take like two, three losses or even four losses, and then you might win like maybe on average 6 out of 10. And basically, if you're able to accept that, you do your proper risk management plan again. You need to reach a stage where taking a loss shouldn't impact you. If you're taking a loss and it can't impact you psychologically, the most common factor I would say really is because one trader risks too much and therefore it impact them individually. The other aspect is if they come in with the mindset and perspective that they want to win or then obviously that will impact their psychology too, right? So I think the main focus here is one, the acceptance of losing is part of it, and two, the risk aspect, how you manage your lot size in such a way that if you take losses, you're fine with it.
All right. So another question here is asking what is the best framework that is easy to be adapted for both casual and active traders?
Right. Good questions. So I would say the framework that I presented today, again, I would call it more of a the baseline, the foundation that I think every trader would need to eventually have, right? So like doesn't matter what technique strategy you use, you need to have a way to identify direction. You need to have a way to identify how you're gonna put your end stops and targets. Um, so in a way, it's like a common sense thing in how you want to approach trading. Right? Of course, there are more complex method in determining direction. There's more complex method in executing a trade. Um, but for today's point of view, right, it's really to give you that awareness of what you need to establish in order to build up a kind of like consistent and profitable trading plan, right? You need to have the elements of direction and set up the minimum. Okay, the bare minimum, you need to have a way to identify buy or sell, where to buy, where to sell, where to put your stops, and etc. Right. So from today's sharing, hopefully what you want to take away is you you move forward, you start to realize the direction you take in your analysis method seems to be not as accurate, then at least you have the clarity to know, oh, I will need to work on my directional forecast, right? And if today you realize that in your trading journey, you start to realize, oh, I'm able to pick the direction pretty okay, pretty high probability, but I realized that my entry point often leads to like drawdown first before eventually moving in a direction. Then with this framework, you start to realize that, oh, now I need to work on my timing, I need to work on my setup. Right? So hopefully after today's session, you gain that clarity in knowing what aspect within your trading itself to actually work on to improve the results, right? And I think that's one of the things that I would love that attendees today will be able to give through the DSE framework.
All right, there's a question by Bazlisham Baharum. Very interesting question. AI or robot trading is becoming more popular now. It is with slower returns, but consistent. What is your opinion on this?
Yeah, I would say, I mean, it's becoming more popular, but this kind of EA trade automation, robot trading has been in the industry, I think like almost for close to 10 years, I would say. Um, different takes on it. Some traders uses it for high risk, high return. Some traders uses it for more consistent, lower risk, but not as high return. At the end of the day, it's more choice and preference, right? What is the objective of you using, what objective of you using algo robot trading? Okay. Personally, been I have accounts running on robot trading as well, since 2021, and my approach on that is always going safe, sustainable, and of course, kind of like a little bit more on the consistency in the result. Um, and it's really enjoyable as well because at the end of the day, you don't need a fast return, right? You don't need to have every trading account or strategy giving you like high returns. Okay. Sometimes as your capital grow, you start to realize that all you need is just consistency and all you need is slightly lower risk to protect your capital. And it's more than enough. All right. So to me, I think it really depends on the stages or the phases of your personal trading journey. Are you looking to aggressively grow your capital, or are you at the stage where you just need to have some consistent return, right? Then obviously you'll be like managing your risk a little bit better. You'll be doing lower risk. You don't need very high returns.
So another question here, how long did it take for you to stay consistent in this industry?
I started back in 2012. So it took me about close to 2 years, I would say, around there, two years-ish. But again, a lot of misunderstanding in terms of like the duration, right? Because I would put it in the perspective where it really also depends on not just the duration, but how actively you're putting in the effort, right? If today you only spend a day within a week to really work on your trading, versus another trader who spent like 10 days in a week trading, then yeah, it's still 1 week, but trader A put in a day of work and then trader B put in 5 days of work within a week itself, right? So it's not fair to say, oh, you need like 6 months, you need 1 year, because in that one month, if you only spend 1 day, in 6 months, you essentially only spend 6 days of work, right? So the duration itself for me may not be directly relevant in comparison to what is the work that you need to put in as well. And there's really no need to compare because again, everyone is at their different stages, and I mean, give or take, I mean, to be fair, um, you can't expect overnight success. You can't expect like, oh, within a week, within 2 weeks, you become a consistent trader. It's a profession at the end of the day. You need to give it sufficient work. You need to give it effort. So I would say I've witnessed some of the fastest traders, I mean, from zero to potentially able to kind of like manage their risk, gain a little bit of traction in their results and outcome, somewhere between 6 months, give or take. Okay, depending again at the end of the day how much effort that trader is putting in. Yeah, so that's my response to that.
Amazing. Thank you so much to all of you for all the questions today. I hope that we have addressed all your queries and concerns well. But if you have any other questions in the future, no worries. You can just reach out to us on to our live team chat through the Bolt Prime website. So that concludes our webinar today. And Kar Yong, before we end, do you have any words for our attendees today?
All the best to your trading journey. And of course, yeah, put in the work. At the end of the day, it's definitely going to be a rewarding one.
Thank you so much again, Kayong, for being with us and sharing your expertise, your insights with us today. And of course, special thanks to all of you for spending your Friday evening with us. And we at Bull Prime are excited to stay in touch and guide you throughout your trading journey. So thanks, everyone, and enjoy your weekend.